have a chance to review your resume, but Sue, thank you for joining us. I know you have a background. Were you on the investment side for a while?
I was, yes. So I've been with Brown-Forman now a little over 16 years. In this role for a bit over 5. But as you mentioned, prior to joining Brown-Forman in 2009, I was actually on both the buy side and the sell side for about 13 years. So I felt like coming into the investor relations role was kind of a homecoming for me in a way, in that I had buy side and sell side experience, and now able to bring the corporate experience as well. So as I look at myself as a 3-legged stool now.
You're like, I know what these people are going to ask me. That's what you're thinking.
Exactly. I talk to myself a lot. Wear this hat and then wear that hat. But in all seriousness, it actually has been of great value in this role to be able to anticipate questions that the investment community will ask of us, to ensure that the management team is well prepared to respond to those questions, because the last thing that you want as an investor relations professional is to have your management team and not have an answer to a question. And so we do a lot of preparation, and in order to do that, though, you have to be able to anticipate what people are going to ask. And it is certainly helpful when you've sat in that seat before and you know what people are going to ask, because you would ask that question yourself.
All right, well, that's terrific. We'll look forward to a good session here. Without further ado, why don't you give us a 1 or 2 minute overview, and then we'll just turn over to the students. If the students would raise their hand on the Teams call, then I'll recognize them in the order that they raise their hand. So if you start us off.
Fantastic, sure will. So you will all have the ability to read our annual report and our proxy and our SEC filings and any other publicly available information out there. So I won't go through all of the nitty-gritty. What I'd like to take you through, though, are the 3 things that I would like you to remember from our conversation today, and always keep in mind about Brown-Forman as you're doing your research into our company. First and foremost, it is a bit about our history. We were founded in 1870 by George Garvin Brown, and so that means 2 things to us. One, we are a publicly traded yet family-controlled company. So the Brown family are beneficial owners of Brown-Forman Corporation, to the point that they have and control more than 50% of the economic ownership in this company. And why we think that's important is because we believe that having a long-term, focused, committed, and engaged shareholder base gives us a distinct strategic advantage, particularly in business that has aged products and multi-generational brands. And so you will hear us talk a lot about the fact that we manage the business for decades and generations. So that's the first thing. We're a publicly traded yet family-controlled company. The second is that we were founded in 1870 and have successfully navigated many headwinds and tailwinds over our 155-plus year history, with a strong balance sheet and industry-leading return on invested capital. This is a very interesting time in our industry right now, but there have been other interesting times in our 155-year history, which included a period of time in which our product was actually illegal in the United States. We are still in business all of those years later. So yes, things are tough right now, but we look to manage again for the long term and successfully navigate things like prohibition and world wars and pandemics, etc. So those are the 2 things: family controlled, and then successful navigation over a long period of time. And then the last thing that I'll leave you with is our strategic framework. So we rely on 4 strategic pillars. Those are our portfolio, geography, investment, and people. Those are the guiding principles for how we run the company. We have a very strong portfolio of brands. In some cases, we would actually even call some of our brands iconic. From a geographic perspective, we are a global company, but we are still largely in the U.S. and have a lot of opportunity for growth outside of the U.S. and have been evolving our route to consumer to capture that. We also have an excellent capital deployment record with a very consistent and effective capital allocation philosophy that has served the company and our shareholders well. And finally, our people are our greatest asset. And with our people and our values, it really sets our company apart. They anchor us during turbulent times. They propel us in times of prosperity. They're our creative force and our source of inspiration and innovation. So please remember family, long history, and the fact that we've got a very strong strategic framework that helps guide the company. So with that, I'll turn things over to the group. Happy to take your questions.
All right. Thank you. I will remind, I didn't mention it at the beginning, I am recording the call for people to use it for later purposes and for the students that can't get on now. And I'll remind you also that if you have a question, please raise your hand on the app, and then I'll recognize you. I don't see anybody queued up yet, so I'll just start it off first. Be on the bottom. I don't see any people on the... Yeah, go ahead, Brad.
Good. We have one of our students, Jonah Jackson, has a question. Hi. So we're modeling that Brown-Forman is trying to get back to their long-term average as far as inventory turnover rates. Can you tell us how long you expect until you're back to that average? How many years?
So from an inventory perspective, we have not given public guidance on how long we think it would take us to get back to historical levels of inventory. But here are some of the things that I would share with you. We have been public about the fact that we have been reducing our production over the last couple of years in order to bring longer-term supply back in line with what we estimate to be longer-term demand. So that means we are looking to reduce inventory levels. That's at the aged barrel inventories. We also have been publicly saying, though, that we are looking to bring down our finished goods inventories because during the pandemic cycle, there were a lot of supply chain challenges in which we wound up having our inventories actually get down to very abnormally low levels. We had to then take them up to higher than average levels to begin to refill the supply chain. And right about that same time is when you saw a slowdown in consumer demand. And so we have been talking about the fact that we are been looking to reduce those finished goods inventories. We somewhat put a pause on that, though, about a year ago when the tariff conversations started to arise, in that we wanted to be able to have some tariff mitigation strategies, which required us to hold inventory, which stopped or slowed the level of reduction that we had at the time. But we did just say on our last call, our last earnings call, that we are looking that now that the I always hesitate to say these words, the tariff environment has somewhat stabilized, because in 2 seconds there'll be a tweet. But in our estimation, things have quieted down, which is making us feel a bit more comfortable about easing on some of those tariff mitigation strategies, as the tariffs have not been as cumbersome or onerous, I think, as some people had expected. And so our expectation is that we would start to resume lowering our finished goods inventories. So those are the two comments from a barreled whiskey perspective, and then from our finished goods inventory perspective that we've shared. It also, though, just depends on consumer demand. If consumer demand accelerates, then we may be able to lower those inventory levels faster than we expected. If consumer demand slows from where it is, then obviously it would take us longer. Hence why we don't have an actual projection for a number of years.
Okay, and then going off of that, for 2026 specifically, can you give us some guidance on operating cash flow growth for fiscal year 2026?
So from a cash flow perspective, what we have said, so we haven't given actual numerical guidance on that number. But what we have said is that we are expecting to improve our free cash flow moving forward. You can actually take a cue from the fact that if you noted in our second quarter earnings release, we added Schedule E, which is a free cash flow calculation. This is the first time that we've included free cash flow in our earnings release in probably the better part of a decade. Which hopefully should give you reassurances that this is an area of focus for us, and also maybe an area where we strongly feel that there's going to be good news moving forward, or else we wouldn't have put it in there, because we know that you're going to be looking at it now in upcoming quarters. But there are two main drivers to that free cash flow expansion. One is what we just talked about. Getting down our finished goods inventory frees up that working capital, which should help us generate additional cash flow. But also capital expenditures. So if you look back at the last 5 years of CapEx for us, you would note that it would be higher than what you would have seen historically. So what was happening over these last 5 years is that we were expanding our distillery production capabilities. We had public announcements about doubling our capacity at our 2 distilleries here in Kentucky. We also expanded our distillery down in Mexico for our tequilas. And we've been making some expansions to our Scotch distilleries as well, as demand has been strong. So that capital expenditure cycle has now ended. And so we are now getting back to what we would just call maybe more or less, maintenance CapEx. So that reduction in capital expenditures will also help free up additional cash flow.
Okay, thank you very much.
You're very welcome. Thanks for the questions.
Hi, Sue. This is Carly Mitchell. Thank you so much for taking the time to talk with us today. We've looked at the analyst presentation, and we see that there's been a great effort made in marketing. And right now, we're modeling that SG&A expenses are going to grow at a faster rate than sales in the long term, whether sales are up or down. Is this a safe assumption to make?
Great question. So from an advertising and promotion perspective, so that's A&P, our long-term philosophy is to grow A&P spend at the same rate as our top-line growth. So if you're expecting mid-single-digit top-line growth, you should expect mid-single-digit growth in A&P. And you'll see that we've been pretty consistent with that messaging. There are some years where that doesn't match, particularly during the pandemic. But for the most part, we look to try and align our A&P spend, the rate of spend, with our top line.
Okay. Thank you so much.
You're welcome.
We got another one if you got time.
I've got till 4:15.
All right, we'll shoot one more. Chris, stop us if you want to.
Oh, go ahead.
All right, go ahead.
Hi, we're modeling that an ounce and a half of liquor is about 2 times more profitable in a canned cocktail, so like your RTD, than an ounce and a half of it of liquor in a bottle. Would this be safe to assume?
We have publicly said that our RTD products actually carry a lower gross margin than the company average. Now, that being said, if you're looking at the most profitable use of a drop of whiskey, it would be in an RTD, because for what we can charge for an RTD, because most of the product is not spirit, it's mostly mixer, it does actually make the RTDs a better use of our full strength spirits. But when it comes to actually having to then manufacture an RTD product with the numerous cans and cost of shipping, etc., that actually makes the costs for an RTD per net sales higher, meaning your profitability is lower. Does that answer your question?
Thank you.
All right,
Yeah.
I'm going to switch gears there a little bit since,
Okay.
do we have any, that was Senator that asked those questions, correct? So let's move on to,
Yes,
let's go on to Midway. Do you have any questions? Any questions for Midway?
Sorry, Chris. Our team is good for right now. Thank you so much for
All right.
really appreciate this. Thank you.
Oh,
All right.
you're very welcome.
How about Indiana University? Do you have any questions?
Yeah, hi, I'll jump in. Hi, Sue. My question's in regards to Jack Daniel's Tennessee Whiskey and its family of other flavored whiskeys. I was wondering if you have an idea of percentage of net sales that you can allocate to the Jack Daniel's family brand. And then in regards to the increasing popularity of the RTD drinks, if you feel like that percentage will change in the future.
Gotcha. Yeah, so we don't publicly disclose brands as a percentage of total net sales, but if you go into our SEC filings, our 10Ks do break out by spirit category. So you will see whiskey, RTDs, tequilas, etc. And so from a whiskey perspective, which would include more than just the Jack Daniel's family, but I will say is predominantly the Jack Daniel's family, you're at over 80% of our net sales. So we are an American whiskey company and reliant upon that category. From the perspective of full strength products versus RTDs. So we have had RTDs in our portfolio actually since the early 90s, so well over 30 years. I think people had no idea we had RTDs until about 3 years ago when we announced the relationship with the Coca-Cola company for the Jack and Coke RTD. Then all of a sudden people started asking a lot of questions about RTDs and found out that RTDs has actually been the second largest part of our overall portfolio now for the better part of 3 decades. But it's mainly, RTDs are mainly found for us in Australia and Germany. Those are our 2 largest RTD markets. And then followed by Mexico, which is not a whiskey-based RTD, but actually a tequila-based RTD called New Mix. And so we use RTDs for a couple of purposes. One would be for recruitment into the family of brands. And then second is marketing. So when you walk around with an RTD, you can see very clearly what somebody is drinking. So if you have a Jack and Coke in your hand, people know you're drinking Jack Daniel's and Coca-Cola. And so that enables us, we call that can in hand. That enables us to have millions and millions of consumer impressions, because if you look at a Jack Daniel's RTD, that Jack Daniel's trademark is front and center on that can. And so we look at it from not only marketing the RTD, but when you see that Jack Daniel's trademark, it also helps then to advertise and market for Jack Daniel's Tennessee Whiskey, and then Jack Daniel's Tennessee Honey and Apple and Fire, Gentleman Jack, Single Barrel, like all of the family of brands can be helped by the advertising that you get just from an RTD can. In addition to that, though, as I mentioned, recruitment is also a way to use an RTD to get a consumer into the family of brands. And so either from a convenience factor, an affordability factor, a flavor profile, RTDs are a way to introduce consumers to the full strength family. They are distinct occasions. Like you're not going to take a big bottle of Jack Daniel's and a 2-liter Coke down to the beach, but you might pack your cooler with a Jack and Coke RTD. If you're, at home entertaining, you're probably not going to just want to crack open a can for your guests. You're probably going to want to make them a cocktail. And so we have found that there are 2 very distinct consumer occasions for when the consumer uses full strength products and when they use RTD products. so that they don't cannibalize each other. They're actually incremental and serve that consumer occasion. Did that answer your question?
Yeah, thank you so much. And then one last thing, has your data shown that consumers have been trading down?
So we did mention in the second quarter that we did see a change in trend. What we had with regards to premiumization. So a set of data that investors quarter over quarter, at least for all the years that 5+ years that I've been in this role, has been looking at Nielsen takeaway data. It's broken down by price point. And what we have seen up until this last quarter has been that the premium, particularly super premium and above price points, have outperformed the total average. This past quarter, we saw premium and standard brands outperforming. So it is one data point. We don't know yet whether this is a change in trend and whether this is truly trade down because of economic reasons, or if it's a change in the thoughts of the consumer premiumizing. We'll have more data as we get through incremental quarters, but we did share that we did see for the first time in a very long time where the super premium and above price points did not outperform the overall total.
Great. Thank you so much.
You're welcome.
All right. Do we have any questions from the University of Louisville?
I'll probably have a quick question here. First, thank you very much for your time. And after I got the notice that we are going to work on Brown-Forman, I took a very quick look at its share price over the last 5 to 10 years. What I realized that COVID-19 pandemic was a pretty bad hit for a lot of in the industries in the world, but it's actually turned out to be a pretty good thing for your company, which also means that afterwards, Brown-Forman actually had some kind of headwind since the pandemic issue went away. So my question would be from a company level, what kind of plans you guys have trying to reverse this trend? Thank you.
You're very welcome. I will phrase your question as I'd say the number one question that we are being asked, and it all roots itself in whether we believe what's happening in the industry is cyclical or if it's structural. I'll cut to the chase. We don't have the answer, nor does anybody else yet. But it is one of the reasons why there's been a lot of pressure, not only on our company, but also if you look at our peers and our competitors, this has been a concern across the entire beverage alcohol category. We, along with our competitors and peers, have believed and continue to believe that the headwinds that we've been seeing are largely cyclical, economically driven. But yet there are structural factors that people will call out. The big three are GLP-1s, cannabis, mainly the beverage THC products, and then Gen Z and the behavior tied closely to health and wellness. And so while we acknowledge that there are headwinds from those three structural factors that I've just shared with you, we don't believe that they are the leading reason why we've seen a slowdown in the consumption or sales trends for the industry. We still do believe that it is largely economically driven, and once the consumer has additional discretionary income and greater confidence in the future, that they will start to spend again. We also want to acknowledge that there has been, and this is a decades-long trend of a mega consumer trend of drinking less but better. And so you can call that premiumization, you can call that moderation, but it's something that's been going on for much longer, I mean, even pre-COVID. So it's behaviors I think that people are concerned about today, but it was a trend that we actually identified again well over a decade ago and began to evolve our portfolio of brands to ensure that we were focusing in on the better part of what people were drinking. And so what you've seen us do over the last 10 years is sell or dispose of our standard priced and below brands, or brands that were more regionally focused, mainly in the U.S., but you would have seen like Finlandia vodka, for example, had very large exposure to Poland and Russia. What do we replace those brands with? We replace those brands with super premium and above brands that are global. So you would have seen us buy brands like Diplomatico Rum, Gin Mare Gin, Forge Gin, right? So our single malt Scotch portfolio. So the idea behind this is that we are looking to meet the consumer where they are, and where the consumer has been trending, and we anticipate will continue to trend over the longer term, is to those super premium and above products.
Thank you very much. Just when you actually give us this very helpful feedback, I was wondering whether I can ask one follow-up question, which is that you actually mentioned that you actually have some discussion with your peers as well. So, what kind of company do you view as your peers, and are they also publicly listed company, or are they actually private?